everybody, looking at XEQT. It's 25 and invested, and we are looking at the Blackrock's fact sheets today. Why XEQT? I'm going to be reading this. If you don't have to listen to me read it, you can actually go to the Blackrock website, type in XEQT, and see these yourself. At the bottom of the page, there's a lot of downloads and descriptions and briefs that you can read over to make a little more educated decision. In this video, we're just going to be glossing it over, taking a bit more of a brief look at it as a person who isn't as diverse in investing and in the language used in this article or in this fact sheet. So yeah, we're going to go why XEQT. A simple and efficient way to gain exposure to a portfolio of ETFs that is broadly diversified across regions in one convenient package. Continuously monitored and automatically rebalanced as needed in order to maintain asset class target weights. A low-cost fee structure that allows investors to keep more of what they earn. So we're going to go over that in a second. Investing objective. The fund seeks to provide long-term capital growth by investing primarily in one or more exchange-traded funds managed by Blackrock Canada or an affiliate that provides exposure to equity securities. So in this basket of ETFs, you own only stocks. So instead of owning cash or having reserve, it is 99.93% stocks. In this company that was, or in this ETF that was made in 2019, there are 9,569 companies and 4 total holdings. Those 4 holdings are other ETFs. The net assets under discrepancy here are 1,100,000,000. Jesus, a lot of money. It's a big ETF. Investment program, it does have a drip. It does have yearly distributions as well. It's not yearly, it's actually quarterly. Every 3 months you get a small dividend of 1.3% right now, because it is down. When I started contributing, it was maybe 1.1%. This ETF will pay the dividend, and it fluctuates a lot more than I thought it would. 1 month you get 7 cents per share, another month you'll get 14 cents, and then you'll get 8 cents, and then you'll get 12 cents. You know, it's a little more, it goes up and down a lot more. So it seems like every half year you get like a 14 cent, and then every 3 months you get an 8 cent, you know, so a little more fluctuation there. Not a bad thing. I'm not really in it for the dividend. I'm more in it for the appreciation value, and 1.3% is lower than the average, so not bad. There's a lot of language here that, honestly, sustainability characteristics, I don't really understand this page. I am going to gloss it over because there's a lot of language that, man, I don't even know what temperature means as opposed to a stock. And I could read that, but honestly, I just don't think it's worth it for an average person. It's not as important of information as a new investor. Maybe it's super important, and maybe I have no idea what I'm talking about. That's up to you to decide. Management fee of 0.18. Super low management fee. You could pay 1 to 1.5% at a bank. This is a tenth, or probably a seventh of that to a fifth of that. Much cheaper, much more reasonable to pay for a company that is going to be managing or automatically rebalancing. Because it automatically rebalances and it doesn't take that much effort to maintain, you pay a low expense fee. The risk indicator, low to medium. That's good. I wanted to take on a little more risk, maybe not quite into the medium range, and certainly not like a bond, which is a low risk to a no risk. I'm looking to take on a little bit more risk, and I'll explain why that's important right now. This ETF holds the core S&P total US stock index, ETF, the iShares S&P and TSX cap, which is the Canadian version of the S&P, the iShares EAFE. Don't quite know what that one is or what's in it. And the iShares Core MCI Emerging Markets, which the emerging markets is more intriguing to me because that is what I'm looking for when I'm saying taking on more risk. When you own the emerging markets, you own a little more developing countries, India, China, Brazil is another one. They're in there and they are lower in scale than the Canadian and US. I wanted most of my money in US and Canada. This is a great one. I also wanted money elsewhere in the world. Again, this is why I own it. In this fund, we have about 70%, almost exactly 70% between Canada and US. More in US, they typically average a lot better returns than Canada. So I'm happy with that again. However, Japan, UK, Switzerland, France, Australia, China, Brazil is in the others portion. Those are other countries that you own assets in, part of those 9,569 companies. You want to be a part of the growth of the world, not just the growth of one country, which is why, again, have subscribed to XEQT. It has appealing things that I wanted. And it was a low cost. It paid a reasonable dividend. That's why I'm here. There are other things that you can have that you can take a look at, fact sheets, ETF facts, the product brief, other things that BlackRock has given to us to make a more educated decision. And there are many other ETFs like this. VEQT is the Vanguard version of this fund, of this ETF. I suggest you take a look and see what jumps out at you that you want to own. Maybe you want to take on more risk, maybe less. I'm 25, 26. I have a long time to invest and I have a long time to take on risk. So I wanted an ETF that reflected that, but also had less than that because I valued more safety or less volatility than something that would be just the emerging markets ETF. Anyways, guys, I'll see you in the next one. Peace.